Will a drop in the market affect dividend stocks? This is the most probing question waiting through the minds of many able investors, especially new ones who are just about starting their game in the investment journey. Conversely, the simple and quick response is no. The stock market has no such effect on the amount of dividend payouts. Therefore, when the market crashes, there would be no adverse effect on dividend stocks. Confused as to how? You don't need to worry or panic. This video is right on course for you. Today, we unleash the possible turnouts should the market crash. Stocks, also called shares of a company, is a fraction or a percentage that represents ownership equity in that company. It gives shareholders voting rights alongside a residual claim on corporate earnings in the form of capital gains and dividends. Whereas the stock market is where individuals and investors come together to buy and sell shares in a public domain. Hitherto, the prices of stocks are set by supply and demand in the market as buyers and sellers place their bids. Dividend stocks, on the other hand, are payment portions of a company's earnings distributed to its shareholders. That being said, let's set the ball rolling on today's video as we talk about what will happen to dividend stocks if the market crashes. What causes the stock market to crush? During 1907 and 1908, stock prices depreciated by nearly 50% due to a large variety of reasons, led by the manipulation of copper stocks by the Knickerbocker Trust Company. Stocks of United Copper rose considerably up to October and thereafter crashed, resulting in a panic. Several investment trusts and banks which had invested their capital in the stock market reduced and began closing down. Further bank runs were prevented due to the intervention of J.P. Morgan. The panic continued to 1908 and led to the establishment of the Federal Reserve in 1913. A stock market crash is a sudden and unprecedented decline of stock prices across a major cross-section of a stock market, resulting in a tremendous loss of money. Crashes are majorly driven by underlying economic factors, natural disasters, speculations, or investor panic. What will happen to dividend stocks if the market crashes? Nothing really happens to dividend stocks when the market crashes, unless the company cuts or suspends the dividend. You will more often than not see companies cut their dividends during severe economic crash. Since dividends are not a function of stock price, market fluctuations and stock price fluctuations on their own do not affect a company's dividend payments. Generally, when the market crashes, it is because of a poor economy. Share prices drop normally when the company is not performing well or investors lose trust in the market and the company. As an investor, you want return for your shares and the money you have tied up with a company. If a company cannot make a profit, you would probably sell your shares and invest elsewhere, which is likely to drive the price down when enough shareholders feel the same. But what causes a company to raise or lower its dividend? The simple response is cash flow. The higher the profits a company makes after paying for the things that keeps it running smoothly, such as salaries, research and development, marketing, etc., the higher the amount of dividend payout and vice versa. To put it in simple terms, the cash flow of a company is the earnings and profitability and how much money the company has made, subtracting the cost of its operations. Dividends basically stop when a company is no longer profitable, and company dividends are issued to shareholders when the individual company makes a profit. When a company pays dividend to shareholders, the board of directors are imperatively showing that reinvesting all of the company's profits to attain further growth will not offer the shareholders as high a return as a dividend distribution would. That said, companies offer a dividend as extra inducement for investors to purchase their stock. Furthermore, a steadily increasing dividend payout is a show-off of a successful company. Therefore, it is agreed that a company's steady or increasing profitability will mainly lead to a steady or increasing dividend ratio, and a reduction in profit will lead the company to reduce or delete its dividends. Most companies in the U.S. are reluctant to depreciate their dividend rates because it triggers investors not to invest. Losing in profits is one factor crushing the stock market for many firms. The biggest stock market crashes includes 1929 stock market crash. The worst stock market crash in history began in 1929 and was one of the catalysts of the Great Depression. The crash abruptly brought an end to a period known as the Roaring Twenties, during which the economy expanded significantly and the stock market boomed. The Dow Jones Industrial Average rose from 63 points in August 1921 to 381 points by September of 1929, a six-fold increase. It started to decline from its peak on September 3, before progressing within a two-day crash on Monday, October 28 and Tuesday, October 29. The Dow on what is now known as Black Monday fell merely by 13% and depreciated by another almost 12% on what is referred to as Black Tuesday. By mid-November 1929, the Dow had lost about half its value. The stock market was bearish, meaning that its value had declined by more than 20%. The Dow continued to lose value until the summer of 1932, when it bottomed out at 41 points, a heart-wrenching 89% below its peak. The Dow didn't regain its pre-crash value until 1954. The main cause of the 1929 stock market crash was excessive leverage. Many individual investors and investment trusts had begun buying stocks on margin, meaning that they paid only 10% of the value of a stock to acquire it under the terms of a margin loan. The investment trusts also often purchased shares of other highly leveraged investment trusts, making the trusts' fates highly intertwined. Consumers, too, increasingly purchased items on credit. When the debt bubble burst, it caused the greatest stock market and economic crash in modern history. Black Monday crash of 1987. On Monday, October 19, 1987, the Dow Jones Industrial Average plunged by nearly 22%. Black Monday, as the day is now known, marks the biggest single-day decline in stock market history. The remainder of the month wasn't much better. By the start of November 1987, most of the major stock market indexes had lost more than 20% of their value. No single event caused the stock market to crash in 1987. Instead, a series of factors drove the sell-off, including a widening U.S. trade deficit, computerized trading, and tensions in the Middle East. The rise of program trading, which occurs when computers make automated trades, likely played the biggest role in this crash. The computers tended to produce more buy orders when prices were rising and more sell orders when prices fell. As those sell orders flooded the market on October 19, it caused other investors to sell in a panic. Because the Black Monday crash was caused majorly by programmatic trading rather than an economic problem, the stock market recovered relatively quickly. The Dow started rebounding in November 1987 and recouped all its losses by September of 1989. Dot-com bubble of 1999 to 2000. During the late 1990s, the values of internet-based stocks rose sharply. As a result, the technology-dominated NASDAQ Composite Index surged from 1,000 points in 1995 to more than 5,000 in 2000. But in early 2001, the dot-com stock bubble began to burst. The NASDAQ peaked at 5,048.62 points on March 10. The index would go on to plummet by 76.81% until it reached a low of 1,139.90 points on October 4, 2002. The primary cause of this crash was overvalued internet stocks. Many investors speculated that dot-com companies, even those without revenues, would one day become extremely profitable. As a result, they poured money into the sector, driving up the valuation of every company with .com in its name. This stock market bubble burst when the Federal Reserve tightened its monetary policy, constraining the flow of capital. The NASDAQ did not again rise to its 2001 peak until almost 15 years later. Coronavirus crash of 2020. This is the most recent stock market crash that occurred in 2020 as COVID-19 spread nationwide. During the week of February 24, the Dow Jones and S&P 500 lost 11% and 12%, respectively, making history as the biggest weekly declines to occur since the financial crisis of 2008. The Dow would go on to decline by 9.99% on March 12, its largest one-day drop since Black Monday of 1987, followed by an even deeper plunge of 12.9% on March 16. However, unlike prior crashes whose recoveries took years, the stock market rebounded to its pre-pandemic peak by May of 2020. Fueling that rapid recovery was an enormous sum of money, with the Federal Reserve slashing interest rates and adding $1.5 trillion into money markets and Congress passing it, a $2.2 trillion aid package at the end of March. A downturn in the market doesn't necessarily mean your investment is going to go down the mud. Even when markets are in a great deal of uncertainties, it is still liable to make money on stocks. For investors facing a falling market, stocks with a high dividend yield can be a good investment. In many cases, stocks that offer a high yield are often a safer bet than growth stocks. Many retirement-aged investors also rely on dividends to make ends meet. The idea is to receive a network of passive, predictable, and growing income that is independent of fickle stock prices. I hope you enjoyed today's video. Thanks for watching.